All right, everyone. Thank you for coming to our annual State of the Market. Everyone, please put your hands together and help me welcome the founder and CEO of Swan Capital, Andrew McNair.
Thank you for coming tonight. Swan Capital stands for Sleep Well at Night. And I love this event so much because we take time to help you try to sleep well at night by giving you the information you need to know. There is not a lack of information. There are so many fear mongers out there, so many people claiming to know what's next. And we do this event to try to clear out the clutter, to give you the information that you need so you can make wise decisions about your retirement. And so I want to spend the next 35 to 45 minutes pulling the crystal ball out from underneath the conference table, sharing you what I think could lie ahead for the next 6 months to a year. And so I hope you're ready, because we have a lot to cover tonight. What I first want to get out of the way is that questions are welcomed here. That I bet I won't cover everything you were thinking about, every question that you want answered. And so bravely, I'm going to open it up for Q&A, which is very scary to do. And so there will be a time for Q&A. And if you have questions about what has to do with your personal finances, it'll be hard to answer that on a big group setting. But if you have general questions that you are thinking about, I bet you someone next to you is thinking it too. So if you'll write that down, write that question down, I'll be happy to try to answer that to the best of my ability, or I may have to phone a friend and call you back. But we'll give it our best shot. A couple formalities is that this is not personal financial advice to you. All I can see is bright lights, mostly in my eyes, so I can't even see every single one of you. So let alone give you personal financial advice to your situation. But when we specialized with Swan Capital helping retirees, many of your situations are similar. So this information is going to be, again, especially focused to a retiree and that phase of life. But again, it's not personal financial advice. Here's our agenda. We're going to keep it very simple. We're going to talk about 4 major things. First, we're going to talk about how the market has performed in 2023. We're going to then talk about what's driving the market performance into this first quarter, and then what may lay ahead. And again, that's always risky business when you pull out that crystal ball, because it does get really fuzzy after a day or two. And then lastly, I'm going to talk about the most important part, is that it's out of our control what the economy is going to do, but we can control our personal economy. And that is what I'm going to try to give you the information to do to help your family navigate whatever lies ahead. So let's jump right into the first question. How has the market performed? Well, look at that very manic depressive market that we have on our hands. We started the year in March with SVB, one of the largest bank failures in history. Pretty scary when we got that news. I was privy to some information about that, and it was a very scary time to know that, is this going to be a bank run like we saw in the 1920s? Is it going to be something that is contagious? And that was the conversation. And I think everyone kind of held their breath. The market definitely took a big, deep breath. And then the market shrugged it off just in time for that banking crisis to not end when First Republic, so after a $212 billion asset bank like SVB went under, then we have First Republic right behind it, which sold to JP Morgan after its assets received by FDIC for $10 billion. So these were some scary moments. And then again, the market just shrugged it off. The market had a really nice run, then a huge dip. And this was interesting because the Fed had decided that no more interest rate hikes for a time, that at 5.25 to 5.5 was just plenty. Well, the market rebound really well, just in time for the Israel and Hamas right on the Gaza Strip, what felt like maybe World War III was breaking out. And then the market took a big deep breath and said, is this going to be a big deal? We already have so many geopolitical events. And then the market shrugged it off and kept on going up. And we're going to talk about why and what's driving that. So we ended the year with a 24% return on the S&P 500. But it can be kind of misleading in some ways because, or can it? I don't have a clicker access. Oh, there it is. There it is. So what's driving that 24%? I really want to zoom into the S&P 500 for you. So the S&P 500 is made up of 500 large U.S. companies that makes up that index. And you've heard me say this before, that the S&P 500 is not a perfect index. It is made up of 500 large, only U.S. companies, and it's market weighted specifically right now to 7 major companies. And this is a stat you might want to know, is that 205 of the S&P 500 companies are not even profitable. So 205, nearly half of them are not profitable. But the market had this great year, Andrew, 24% return. Well, there's some reason for this. 3 major sectors, as you can see, with IT, consumer discretionary, really clocking in 40%, high double-digit numbers. I mean, we haven't seen numbers like that in a sector since like the 1990s in that IT department. So it's really amazing to see the growth. We've seen that. Now, some of that's because of the AI craze and companies that had triple-digit returns like NVIDIA, for example, that people ran into. And so you can see that it's very consolidated. And I'm going to talk a little bit more about that because I think it's important not to forget that this S&P 500 index has some issues. So I'm doing something wrong. I got to press the right button. There it is. So large companies and large impact. You can see the 3 major companies right now of the Magnificent Seven. You have Apple, Microsoft, NVIDIA making up nearly 20% of the market. And it's just astounding that they have pushed this growth that, and I'm going to talk about this a little bit later, that you have, 90% of the returns made up of top 10 companies. So we have a very big concentration, and this is not the first time that it's happened. We've seen that in the Nifty Thrifty. We've seen that multiple times. But anytime we've seen a concentration into just a few companies, it can start off balancing the market. When those companies start to have bad days, you're really going to feel it throughout the S&P 500 returns. So that brings me up to a lot of people running into the domestic market because international stocks have not performed over the last decade. But that doesn't mean that we should shy away, get rid of international stocks altogether. Definitely not. As you can see with this 2 standard deviations, that this is what we call a price to earning ratio, meaning a company's earnings compared to its price. International companies are historically on sale. And again, they have their own bag of problems overseas in Europe and Asia, but they are on sale. And this is why our portfolios do have exposure to international equities, because we don't want to miss when the tide does change, that the American empire has its really great run and then it has a season of winter. We have to be prepared for that with some cheap international stocks that are on for sale. The other thing that has been interesting to watch is the real estate market in 2023. This is a fascinating graph. It shows that 26% of all mortgages are under 3%. 26%. The next 45% are made up of mortgages that U.S. investors in homes have a 3 to 4% mortgage rate. And only 6% have above 6%. So what's the likelihood that anybody's going to be moving anytime soon? Probably not. If you have a mortgage, you're pretty happy that you do. Because I was talking about this just in line with someone, how it is hard that prices are higher, that interest rates are higher. And again, they're not fulfilling enough new home builds, which is only furthering the issue. So we definitely need more home builds for this situation to get better. Continuing on, what is driving market performance going forward? These are the pistons that are under the economic hood. And I will not sugarcoat it. It does not look good. There are some things that cause me some concern, and there's some things that obviously give me some warm and fuzzies. I will tell you that green is a tailwind, and the reds are definitely headwinds. And we have some serious headwinds that I'm going to talk about. But the things that have improved is the Fed isn't talking about interest rate increases. And I talked about it previous halftime reports in the state of the markets. I don't like the emphasis that we have on the Fed talking about interest rates, but it is manipulating the economy to a certain extent. And so that's one thing that is improving. We also know that consumers are very, very resilient. And that might be because we're stubborn and we keep on spending even past when we should. But I also believe that consumers know what they need to do. They know they need to work extra hours. They know they need to get pay raises and work harder and longer hours. But I am concerned that consumers are usually the last one to know before the shoe has fell. And they will keep on spending. And I'm going to talk about delinquencies in just a second. But one major headwind that we need to talk about is equity market evaluation. There's two indicators. You've heard me talk about them on this stage before. Number one is the Shiller PE ratio. We're already at a 33 Shiller PE ratio. That is adjusted for inflation, how much a company earns versus what it's worth or what the market thinks it's worth. At the end of the day, every company is made up of its earnings. That's why you would buy a company, because you're buying a company because it spits out returns and actually makes an income, which 205 of the S&P 500 companies actually don't. But what we're seeing is a real quick return to where pre-COVID was. Pre-COVID, we were at a 37. The dot-com crash was a 42. And the Great Depression was at a 30. So if we're at 33, nothing really good will start happening after 33, 35, and we're approaching those numbers. And so that's why we're keeping a very close eye on equity market valuation. If you're not praying, you should start praying for world peace, because those geopolitical events is a reoccurring thing we talk about here, and it doesn't seem like it's getting any better. So that is one that also could be a black swan event any day. And so we always keep an eye on that, because that will cause market volatility. There was a big conversation about what a recession is. Are we going into a recession? Will we be in a recession? Is 2024 the year of the recession? Same thing they said about 2023, and then that did not happen. When you look at a recession, what is by definition, a lot of people use the two negative GDPs. So if the gross domestic product of the United States is negative for 2 consecutive cycles, then we're in a recession. But this is a better scorekeeper. This is from the National Bureau of Economic Research. Gives these 6 economic indicators. And you're looking at consumer spending, you're seeing retail sales. The only thing that is really negative at this point is industrial output, and that one is actually not that much of a concern. But again, we're trying to steer and take advantage of it, not just knowing that we're in a recession. That's not as helpful. But I think it's important to understand that there are still positive predictors here that is keeping us out of a definition of a recession. But I don't have to tell you, with inflation for the last 3 years, with tighter monetary policy, it sure does feel like we're in a recession. And I think a lot of American people are exhausted from that. So it may not meet those requirements, but it sure does feel it. I wanted to elaborate on this concentration. This is a very helpful graph. Hopefully you can see it. It shows the returns between just 10 S&P 500 companies compared to the other 490 companies that represent the largest American companies. And as you can see, the top 10 had a great year. They've shrugged off, rising interest rates, because when they add another user on Facebook, on Google, are not really affected by interest rates. So they've had some really good years, but the other companies will either have to catch up. If you have a glass half full perspective, maybe they will catch up. But that is a little troubling that the returns is misleading in the S&P 500. Continuing on, I do want to talk about the Fed. I think I'd be remiss if I didn't talk about some of the legendary quick interest rate maneuvers that the Fed has made. This is showing you the historical Fed's funds rates and what market participants are thinking. And one of the reasons why the market has been doing so well, especially for the last 6 months, is the people are looking to the Fed and they're saying, I think the Fed's going to change their tune. I think that we're going to have 6 rate cuts in 2024. And I think that is really optimistic if you hold that point of view. I personally believe that the Fed needs to hold where they're at. I don't think they will. I think they will probably lower 1 or 2 times at least, especially during an election year. They're supposed to be a very independent part of our federal government, but we will see. So you can see the disparity between blue and green, between what the market thinks and what FOMC, the Fed committee, believes its target will be. So there is a big gap of perspective of what's going to happen in 2024. Continuing on, I do think we need to talk about new technology. Why am I always so bullish about the market? It's because I am long, and I think very positive, hopeful feelings towards drone technology, towards 3D printing, through AI. I think those will change the world as you see it. I mean, it's just like when you think about your parents and what they saw for the 91 years they were alive. What you're going to see for the next 20, 30 years of your retirement is going to look like magic. I mean, what they're 3D printing homes and AI, what it's going to change, and it lays the tracks for more robotics. It's going to change things. And what I've been most fascinated by AI is that it didn't go after the tedious jobs first. It went after, just like when you open Pandora's box, you don't know what's going to happen. It went after graphic artists' jobs. It went after creative jobs like writing, which I think is fascinating. But as you can see, every sector is going to feel this. It has an impact of potentially 300 million jobs globally, and it's going after legal. One of the main jobs it's going after, office administration, those tedious jobs, it's coming for that too. And it will streamline things. And a lot of people look at this as some boogeyman. I don't think so. I think all the people, like a lot of people are asking me, what companies should I invest in? I think a lot of companies, if they're smart, they're going to adapt and use that technology just like every company used the internet. However, Wall Street is very famous for getting ahead of itself. Just like the dot-com crash with the internet did change the world, but it didn't change it overnight, and AI will be probably the same story. It will change the world, but just not overnight. And so you're seeing this with legal, where it's already predicting really well the outcomes of court cases. It's already taking care of in real estate law, helping with contract preparation. So just amazing what that technology can do over time. However, that is one of the reasons why you see triple digits in stocks like NVIDIA. So where are we headed? This is a chart we use all the times. It's just a humbling chart, because some of the greatest minds, the largest institutions that we have in the world, not only just the country, make predictions on where the S&P 500 is going to end this year. And as you can see, J.P. Morgan, Morgan Stanley stand on the more bearish end. And then you see the other institutions like Deutsche Bank on the other end of the spectrum that think the market's going to end over 5,000. And I stand on the belief that it will be a solid year in 2023. Do not play that back to me if it doesn't work out that way. I do think, 2024. I think it will be a strong year in 2024, but only time will tell. I will say this is the time I had full intention of emphasizing and making sure that I get this point across. If you are taking retirement income, and we see equity market valuations are already in the red hot zone, if you're taking income from your investments, the accounts that you're taking investment income, this is the time that you may want to start downshifting. Because we may have another solid year, 2, 3 years, but we are in overvalued territory. We're not in extremely overvalued territory yet, but we're getting there. And so we look at the Buffett indicator, we look at the Shiller PE ratios, 2 ratios to determine where in history, based on valuations, are we. And so if you're taking income from your investments, that income bucket, if you will, is where we need to decide if we want to upshift, not upshift, but downshift. Many of you, we've upshifted over the last 3 years. When we had COVID, we took you from your dividend portfolio, shifted you to growth, and maybe even aggressive. And this might be the time that we downshift you back to dividend. If that is a question, a concern, and you're taking income from one of your investment buckets in the roof, I'm talking just roof accounts that are market related, this is a good time to shoot me an email, to talk about it at your next review, to give Lucas or I a call and say, hey, what do you think? Do you think we need to downshift this portfolio? And we'll be happy to say, nope, coast is clear. If you have things like Roth IRAs that we have you in aggressive, our Swan Aggressive portfolio, we will probably tell you over the phone that needs to be left alone because it's the last account we would ever spend. So we need to be long and think long term on that. So you've heard it here that I'm telling you that this could be a good time to downshift better than any other. Here's what the opposite, the devil's advocate part of me wants to say. If you look at the last time the Fed has stopped any hikes, this is the history over the next 12 to 24 months in the S&P 500 based on the time periods. You can see in the 1980s what happened. You can see, according to this chart, the only time that when the Fed stopped raising rates and the market did not do well is during the dot-com bubble. So, like they say, the famous disclosure that was in the original disclosure that you couldn't read because it's like microscopic is past performance does not promise a future gain. Who's to say that we're going to be one of those 5 or 6 lines in the future? And so that's why I'm telling you here, if you're taking income from your investments, that bucket you may want to downshift. But we may have another 2-3 years before we have some pullbacks. Using quantitative models, just a fancy word of using technology to forecast. This comes from the Vanguard's quantitative models. It shows that Vanguard believes, and I understand where they're coming from, that international is a great opportunity. And it hasn't presented itself. It had a really good couple decades in the past, but in the last decade, it's been a real loser. It has not done well compared to the United States, and that's why we never bet against the United States. Amen right there somewhere. Homer the Brave. So we will never bet against the United States, but we'd be, I think, very short-sighted if we did not just say, hey, we need to have some international exposure here. And that's why you saw some rebalancing in our portfolios. That's why you see it in our portfolios. Even if it has a lackluster return, we have to have it there for diversification because every decade has winners and losers. And oftentimes they're not the same. Now, I know this has probably been on the top of your mind or in the back of your mind somewhere is what about the election? How's that going to impact markets? And I have witnessed in my short lifespan so many wild reactions to politics. I have many funny reactions in the conference room. I'm going to sell everything if Trump gets elected. I'm going to sell everything if Biden gets elected. And the reality is we know that policy mistakes take time. They take time to sow into the economy. And you're seeing some of those policy mistakes, no matter where you stand. I mean, there's policy mistakes that every president and every Congress and every Senate makes. And so you're seeing here, though, a very balanced, this is just the numbers. If you want the facts, here's the facts. That in a divided government, the U.S. economy, the great American empire, doesn't matter. We keep on moving forward with the divided government. And that's how, again, the founding fathers wanted it to be. And so you can see, though, Republican dominated houses and senates actually produce a slightly better return, but so do Democratic parties. But a divided, still nonetheless, it'll still have a good return. So it's not as big of a determinant, at least in the short term. This is a concern. With student loan debt being more and more payments being turned on where people are going to have to start making those payments to student loan, you're already seeing an uptick in auto and consumer debt delinquencies. And that is not a good sign because, again, who's the last to know? The consumer. You would think, well, the consumer's smart. Well, no, they go like a big crowd of lemmings right over the cliff, and they just keep on just spending until it's too late. So this is something we're keeping a close eye on, is those delinquencies and that uptick right there. And one of the reasons why I said that sobering comment about downshifting. So I do want to talk about the positive. I can't control all those different things as much as I'd like to in politics or the economy, or I'd like to tell the Fed what to do. I can only control my personal economy, and you can too. We don't have to be victims here. And that's why I want to talk about the things that we've helped our clients like yourself take advantage of. This is one of our favorite charts to show because I think it is just a very humbling perspective. Just when you think you should give up on the market, when the market drops double digits, 10% down like it did last year, if you'd have got out when it was down 10%, you would have missed out on 24%. It shows the intra-year declines in red compared to the S&P 500 returns in each year. This volatility, as much as the market is manic depressive, gives us an opportunity. If the market thinks things are for sale or overpriced, we want to take advantage of that manic depressive shopkeeper. And so that's why you have the opportunity throughout the year to do Roth conversions that we present to you to say, hey, this is a great opportunity for you to take money from your IRA, sell while it's at a high, and dollar cost average into the market while it's volatile. This is a great time, and we did this last year, and we've done it repeatedly, is taking money from assets that are outside the market, things that zig when the market zags, and buy while the market is down because of opportunities like this, these intra-year declines. The next thing that's very important that we do, at least on a quarterly basis, and sometimes much more frequent during periods like COVID, where the market is a lot more volatile, is rebalancing. And rebalancing does many things. Number one is it maintains the cash that you need in your portfolio. If you're taking income from your investments, this is the place that we want to take it from, as an account that's been rebalanced on a regular basis. The second thing that it does is it makes sure that you don't have too much winners get too far out over their skis. You don't have losers lose too much. We have to buy and sell losers and winners to make sure that we don't have our asset allocations get out of mix. And we also do these portfolio rebalances because they present great opportunities. And some of you have been a part of those great opportunities, like during COVID when oil was cheaper than water. There's always opportunities that present themselves. So some of the things that we did this year is we were out of tilt last year where we had too much in growth on purpose. We actually sold value to get heavier into growth. Well, now we're starting to rebalance. While the market has done well, we are actually shifting that to be more equilibrium between value and growth. The next thing we did is we had some in more emerging markets, and we shifted to more, because the cheap international stocks from emerging markets, to dividend large paying companies. The next thing we did is we shifted our bonds, because short-term bonds were not losing nearly as much as long-term bonds, but the hikes had come to an end. We started shifting to more intermediate, longer-term bonds within the portfolios. So these are the changes that we're making on your behalf. As you know, we manage our SWAN portfolios in-house so that we don't have to look at you and say, I really don't know why that portfolio is not doing well. We can tell you, here's what's underneath the hood of that portfolio, why we made the changes we did, because we manage those in-house thanks to Lucas. Spending plans and income plans. One things that will keep you in a good situation, no matter if we do have market volatility over the next year or two, is having a solid income plan. And this is why inside every client's financial plan, we talk about what's the maximum you can spend, what's the minimum you can spend. Obviously, the minimum you spend makes it my job a lot easier. But I think it's very important to have conversations during the review. If you want to know what's the maximum you can spend, I'm happy to run those numbers again or update them for you. One of the biggest mistakes, you've heard me say it over and over again, is most clients tiptoe into retirement, and that is such a grave mistake. I mean, this life is short at its longest. You need to jump with 2 feet forward into retirement and go start crossing off items off your bucket list. And the reason why you can have that confidence is because you have an income plan. And this is just a very helpful graph. It shows you if you're taking 5 to 6% from your portfolio, how long your portfolios will last. I mean, typically a 20, 25-year period. But if you take 4% off your investments, you might last 35 years. And so if you're only spending 2% of your net worth, 2% of your assets, in addition to your Social Security and your pensions, I know I'm going to get in trouble for this. You're not spending enough. And so if there's some elbows, some hurt ribs tonight, I'm sorry. But the truth is, probably some of you could spend more and should spend more. And I'll help out with that consumer spending, by the way. This is a big decision. Many of you have already made this decision, but the difference between taking Social Security and not, I really like this graph, is it shows the break even for Social Security, but it also shows that someone that delays could be a $300,000, $400,000 decision. That's a very big decision that you're making potentially flippantly. And I would love, you're not bothering me, I'd love for you to send me an email saying, hey, Andrew, I'm really on the fence. I know we talked about delaying for the next 2 years. Before you just pull off the Band-Aid, make an irrevocable decision, send me an email. That's what I'm here to do as your advisor. This is a very fancy chart, but I love this chart. Many of you could be eligible for Signet. If you're an accredited investor, meaning you have over $1 million, or you're a qualified client, meaning you have over $2.2 million, I want to emphasize why we created Signet is because of a graph like this. This graph shows why alternative investments like private equity, hedge funds, and real estate are so important to own. It shows that the sweet spot right here is this chart right here. I want you to just, there's a lot of circles going on, a lot of basketballs dribbling. So I want to talk about that one right there. As you can see, this is a portfolio that's made up of 40% of equities or stocks. Then we have 30% made up of a safe investment class, be it bonds, fixed index annuities, CDs, index CDs, anything that has less risk. And then you have an alternative investment class right there for 30%. Many of the clients that have already invested in Signet have 10, 15 to 20% of their portfolio that's invested in Signet. And what that does is that gives you that differentiator, that asymmetrical risk. And as you can see, the returns and the volatility are really in a good sweet spot, where a 9% return with a lot less volatility. So if you haven't already talked to us about Signet, schedule a call. Here's what you can do. There are some action items that you and your family can do under your roof in your personal economy. The first one is keep us in the loop with life changes. If you're taking a part-time job, this happened at least 5 or 7 times during a review this last year. I had clients that said, hey, I made $2,000, I made $5,000, I made $10,000 doing part-time work. And I'm like, you're just now telling me that? I said, I wish you would have told me earlier so we could have actually put that $5,000 into a Roth as a Roth contribution. They said, oh, but Andrew, I spent the money. I said, I understand that. That's your walking around money doing the part-time work. But if you have life changes where you're working part-time, I can take money from your brokerage account, your CD, your money market, and put it into your Roth. And you spend that money that you're working part-time, driving Uber, whatever you're doing part-time, I can use that as earned income for Roth contributions. This is what I'm talking about, keeping us in the loop with life changes and just not assuming that I know what's going on in your life. Next is inform us if your income needs change. If your elbow's sore after this and your wife or husband says, I told you we should spend more, and you say, I need to change my income, give us a call. Shoot us an email. Say, hey, Andrew, what do you think about us raising our monthly deposit up to $2,000 a month or $5,000 a month? That'd be great. I'd love to see that email. We can run the numbers to see if that is a good fit for your financial plan. Next thing I want to talk about is downshifting. I wanted to be sober. I wanted to be very sincere about my recommendation that if you're taking income from the investments, you're taking income from that one income bucket, that may be a time to downshift. Otherwise, don't be panicked or anything, but this could be a good time to downshift better than other times. Roth conversions, do not let a year pass by. I will try to ensure that a year does not pass by where you take advantage of Roth conversions. This is the last 2 years you have where taxes are on sale. In 2026, tax rates will be more unless a Christmas miracle happens. Unless we have less government spending, tax rates are going to have to go up. And if tax rates go up, everything that you spend money on will be 3 to 5% more. So I'm trying to shift as aggressively as possible, working with your CPA and ours, in shifting your money to tax-free investments, i.e. like the Roth. Increase contributions. If you haven't got our email already, I shared with everyone, if you're still working part-time, you can add more money to your Roth. You can add more money to your Roth 401k. And last is for those 3 years out from retirement, 5 years out from retirement. You will get an email once to twice a year. Lucas sends it out. Is your 401k TSP allocations. If you have allocations at your employer, please send us. You're not bothering us by sending us saying, hey, Andrew, here's my allocations. I know you're not managing this, so here's a copy of your 401k statement so that Lucas and I can say, yep, you need to upshift, downshift. You need to make some changes. Because if you're not careful, when the market goes up 23% inside your 401k, I bet many of you do not have automatic rebalances within your 401k 403b. So very important to do. Couple tax updates. Rhonda, if you haven't met with Rhonda about doing your taxes, she'd be happy to meet with you. And Daphne or Pensacola, I've got some really good glowing review and feedback from Rhonda, meeting with Rhonda, how quick she makes it. If you have questions about tax documents, many of them are on your portal at Schwab, at TD Ameritrade. You will get 2 statements in the mail, but they are available electronically. They come in waves, so you can see the dates there. Again, if you have questions about these tax documents, we want to make sure you do them. Especially many of you who are doing qualified charitable distributions, gifts to your charity, you'll want to make sure, or church, you'll want to make sure that your donations are lining up with your donation statement, so that distribution from your IRA matches up with your donations. Next, Secure Act. There's 2 takeaways, big fancy chart up there that I want you to know. RMDs are now 73, if you forgot. The other second thing you need to know is about 529 plans. Now the 529 plans that you do for your grandchild or child, up to $35,000 can be moved into a Roth IRA if they don't use it for education. If their job just got eliminated by AI while they're going through college, that's a bad joke. It's very important. You know, I was going to say it like that AI chart I showed. If you need me to email you that, you should tell your kids and grandkids to shift that chart, go into construction and being a plumber, because those are the last holdouts for AI. So you can see here that is a really nice mechanism where we can move money from a 529 plan to a Roth. If you haven't spoken to us about it before, setting up a Roth IRA for a grandchild or a child is a very good idea. It is better than a cash gift, because when you give a cash gift, this is made famous by a great book called The Millionaire Mind. It talked about when you give a cash gift, it creates this gravity of extra spending. It creates magnetic spending in their life, because they are in basically a home, a neighborhood they don't belong, and they have to spend more money to belong. And so what can do better for them is putting money into a Roth IRA and setting them up and really priming the pump for them to start investing in their retirement. And even if they're a lifeguard for a month, they can add money to a Roth IRA. Scott, with his young picture there, strapping picture there, is, I'm going to use AI to update that picture, Scott, if he listens to this. Review old estate plan to ensure compliance. This is what he said. He said, Andrew, he said he was going to be here, but he did get sick. And he said, make sure that if you have dust on your legal documents, that you do get a review of that. If things haven't changed in the last 3 to 5 years, you should still probably get a review every 3 to 5 years. It never hurts to have Scott. He does it complimentary. Will review your documents and make sure that it's the way you want it. He will also make sure that your wishes match your legal documents. You could have up-to-date legal documents, but if they don't match your wishes and things have changed, you need to update them. And then I've seen this a lot recently. If you have a life estate, a paid-for home, that is a probatable asset. And I've seen it even in my own clients who I told, you got to fix this. And they have procrastinated. And so you need to make sure you have an enhanced life estate or a trust for your home titling, which is why we have an estate planning attorney who can meet with you. This is scary. I'm going to open this up to a couple Q&A. Any questions? Be bold. There's no way I covered everything.